Have you ever noticed how some people make money easily from dividend investing while others don't? It can be frustrating when your investments aren't growing, especially when you see others doing well. If you want to be a successful investor, it's important to understand the common mistakes people make with dividend investing. Mistake 1. Ignoring the payout ratio. The payout ratio is the percentage of a company's earnings paid out as dividends. It's important because it shows whether a company can continue paying dividends over the long term. A high payout ratio means the company is giving out most of its earnings as dividends, which might seem good at first. However, it could be a red flag, indicating that the company isn't reinvesting enough back into the business. This can hinder future growth and dividend increases. On the other hand, a low payout ratio means the company is keeping more of its earnings for growth, paying off debt, or other strategic uses. It's also crucial to consider the industry standard for payout ratios. For example, utility companies often have higher payout ratios due to stable earnings, while tech companies usually have lower ratios to fund growth and innovation. Example: if you invest $10,000 in a company with a 90% payout ratio, you might initially enjoy high dividends. But if the company's earnings decline by 20%, the high payout ratio means there's little buffer and dividends could be cut. This could reduce your annual dividend from $900 to $720 and also lead to a drop in the stock price. Mistake 2. Chasing high yields. High dividend yields can be tempting, but they often signal underlying problems within a company. A high yield can happen when a company's stock price drops significantly, but it keeps paying the same dividend. This might indicate financial trouble, potential dividend cuts, or no growth prospects. Example: investing $10,000 in a stock with a 12% yield might initially seem great because you get $1,200 annually. But if the company cuts its dividend by 50% due to financial issues, your income drops to $600. If the stock price also falls, your $10,000 investment could shrink further, eroding your returns. Mistake 3. Overlooking dividend growth. Dividend growth is crucial for successful investing. Companies that increase their dividends regularly show financial health and commitment to returning value to shareholders. These companies often have strong business models and competitive advantages. Example: investing $10,000 in a company with a 3% yield but a 10% annual dividend growth rate can be more beneficial over time. Initially, you get $300 annually, but after 10 years, this could grow to $700. After 20 years, you could be getting $1,800 annually, compared to a company with no dividend growth. Mistake 4. Not reinvesting dividends. Reinvesting dividends is a powerful way to grow your wealth. Instead of taking the cash, reinvesting buys more shares, which then generate their own dividends, creating a compounding effect. Example: if you invest $10,000 with a 5% annual dividend yield and reinvest the dividends, assuming a 3% annual stock price increase, your investment could grow to about $20,000 in 10 years. Without reinvesting, you'd still have the original $10,000 plus $5,000 in dividends. Mistake 5. Lack of diversification. Diversification means spreading your investments across different sectors and industries to reduce risk. Relying too heavily on one sector can be risky if that sector experiences a downturn. Example: if you invest $10,000 solely in a high-yield utility stock and the sector faces challenges, your investment could drop significantly. But if you spread your investment across tech, healthcare, consumer goods, and utilities, gains in other sectors can offset losses in utilities. Mistake 6. Short-term focus. Dividend investing requires a long-term perspective. The compounding effect of reinvested dividends works best over time. Selling stocks during market downturns due to short-term thinking can undermine your returns. Example: if you invest with a long-term focus, reinvesting dividends, and diversifying, Your $10,000 investment could potentially grow significantly. Combining these strategies helps you build a stable, growing income stream and protect your investment against market fluctuations. By avoiding these common mistakes, you can significantly enhance your dividend investing strategy and turn a modest investment into a substantial source of income, helping you achieve financial freedom.